Traders Corner is brought to you by IG.
Welcome to Traders Corner. As always, I'm joined by Garth McKenzie, founder and editor of Traders Corner. Garth, welcome.
Hi, Julieta.
Garth, the market's carnage has been quite spectacular to behold in the last week or so. And of course, one wishes that futures close out had happened maybe in the last couple of days, because we might have benefited. That kind of will lead us up to an option structure that you've decided to put on for the portfolio, but we'll talk about that a little bit later. But just to start off on your thoughts on what Brexit has actually prompted on the market.
Yes, well, of course, Brexit was, I don't want to say it was unexpected, although the market reaction certainly indicates that it was largely unexpected. The polling always said it was neck and neck, but the way the markets had responded, the way the pound was trading, the way the betting odds were trading was saying Brexit's not going to happen. Of course, I remember waking up at just before 5 a.m. on Friday morning and seeing the headlines on the news and thinking, oh my goodness, this is really this is a shock outcome, and there's going to be carnage. And there certainly was. I mean, we saw the markets getting absolutely hammered on Friday. That weakness continued into Monday, and today, Tuesday, now it's the third day since the Brexit referendum was announced, the result was announced, and the markets have begun to stabilize. But having said that, there's been a fair amount of technical damage done to these markets.
Yeah. Well, let's start maybe looking at those charts and start. I think the obvious one would be, well, the S&P and then the FTSE.
Yes, so we're going to look at the three big international markets before we then bring it home. So the first one is the S&P 500. Now, this is a weekly chart that I've got up here. So every candlestick pattern on this graph represents 1 week worth of trade. And this is nice because it gives you a big picture of how the market's looking over a longer period of time. This is 3 years worth of trade that you can see on the S&P 500 here. And what I've been going on about for a long time with this chart is the fact that this 50-week moving average, that's that blue line there, that 50-week moving average has begun to roll over. And it started to roll over in August of last year. So it's gradually been heading further and further south. Of course, the markets have been very volatile during that time, and we've seen plenty of up and down trading action since then. But what's quite interesting to note, certainly now, is that we've had this big rally from the February lows. But over the last, I call it since really the beginning of April, this market's kind of chopped along sideways, and it's now got a rounding top look to it. And you can see we've had a couple of these over the last 2 years. We've got that big one in 2015. Then last year, towards the end of the year, we saw it again. And we seem to be forming the same sort of pattern now. And what's noticeable here for me on the S&P 500 is that the price action is once again back beneath the 50-week moving average. And it's the first time this year that we've actually seen the market making a lower low. So that, to me, does kind of signal some caution from a technical standpoint. And obviously, this has all been prompted by Brexit. And I do kind of wonder if this is not the catalyst that could result in further market weakness now during the third quarter of this year. From a technical standpoint, it's quite possible looking here. I just struggle to see what's going to make this market go significantly higher now. To me, the vulnerability still looks like it's kind of stacked more to the downside than the upside.
Especially with the fact that most of the central banks of the world don't have that much left in their arsenal. We've been talking about raising rates. Maybe the Fed would have to cut rates, but it can only cut rates so much, and then you're back to zero. What about the FTSE? Because that'll be an interesting one. Obviously, maybe the effect would be more dramatic. Although, as a lot of people have said, it's not as dramatic as it could have been. Yeah.
What's very interesting about the FTSE here is to note that the FTSE 100 is made up of a lot of global companies that earn their revenue in dollars, in euros, in other currencies other than the pound. So the FTSE 100 is actually quite sensitive to a weakening pound. And what's happened since Brexit is that the pound has got an absolute hiding. When it was 10% weaker in an hour on Friday morning, right? And it's continued to be weak. And the weakening pound has very much the same effect on the FTSE 100 as what a weakening rand has on our top 40, for example. So a weakening pound really does help to actually buoy the FTSE 100. And we've seen it with big heavyweight stocks on the London Stock Exchange, like Unilever, like Reckitt Benckiser, these sort of things, Diageo, those types of companies have really done very well, actually, in the last few days, notwithstanding the fact that the rest of the market has been weak. Yeah. So that's why you see the FTSE 100 holding up relatively well. And that downtrend, nevertheless, is still intact over there. You can see that quite clearly. But the FTSE 100 actually hasn't been hurt as much as what some of the other markets have been, particularly the next one that we'll look at, the Euro Stoxx 50.
Yeah, and maybe just a comment there, the FTSE 250, which covers more of the smaller and mid-cap companies listed in London, shows a lot more damage, interestingly enough.
Yes.
Okay, you mentioned Euro Stoxx 50.
Yeah, so the Euro Stoxx 50 is a nice measure of looking at the overall European markets. You know, we could look at the DAX or we could look at the CAC, but the Euro Stoxx 50 is 50 of the biggest global companies in Europe. And so it's a nice index to track if you really want to look at Europe as a region. And from a technical standpoint here, the damage has actually been more severe in Europe than what it has been on the London Stock Exchange. And what, to me, I mean, I think this market has been in a bear market since April last year when it peaked. There's no doubt that you can see a pattern of lower lows and lower highs over there. This sort of 2,900 area on the Stoxx 50 has been big resistance over the last couple of months. And now we've seen a bear flag forming over there since February this year. And this recent trading action, in fact, this happened before Brexit, but nevertheless, it's been exacerbated since the Brexit result. You've seen that bear flag pattern now breaking to the downside. And strictly speaking, that still, to me, points to further weakness ahead for the Euro Stoxx 50.
I mean, so overall, a bearish point of view, and certainly at the beginning of the year, we were very bearish, and then, you know, the market just rallied, I think, to the surprise of many, and certainly to us, because we had that option structure in place against a market downturn. Yeah. But having said that, well, let's have a look at the top 40 before we discuss the action that you're going to take.
Yeah. Look, this is a chart of our top 40 index. This is a daily chart now, so each candlestick pattern here represents 1 day's worth of trading action. And what's notable here for me is the fact that we've got this lateral support area at about 45,000, which goes back through the lows in April and May, and there's that swing high in February that you can see over there. So that's quite an important level. This trading action over the last few days has now taken the market below 45,000. Now, that for me is a bearish break, but I don't think that we're necessarily just going to continue to collapse from here. But my suspicion is that we probably will rally a bit now, maybe stabilize a little bit, but dependent on the shape and the feel of a rally from here, there's a possibility that we may form some sort of a continuation pattern that then has another leg to the downside. And that's what I kind of want to protect against as we go into the third quarter. Because I do think that if we continue to see further trading action beneath 45,000 on our top 40, then there's a fair chance we come back down towards 42,000 here. So I want to have some sort of protection in place in the event that should happen.
So how are you going to take advantage of this bearishness?
All right, so I'm doing another one of these option structures, which I know get very, very complicated, and some viewers say to me it's a bit too complicated for the show, but I still think it's very, very useful, and we've done these structures for most quarters over the last 2 years, and I'm a big believer that we should continue to do them because they do give us participation to the downside without very much risk if the market should continue to rally. So what I've got on the screen here now is just a chart that sets out the table or the diagram I'm going to build on now. Along the bottom axis here, you've got the different levels on the top 40 index. So you can see 45,000, 46, 47, and so on. On the left-hand side here, you've got the profit and loss. So above the line is profit, below the line is loss, in increments of 5,000 Rand at a time. Now, the first leg of the structure that I've done is I've gone long of one put option with a strike of 45,000, and you can see that illustrated with that payoff line over there, that red line. I've gone long one contract. It's cost me 9,160 Rand to buy that put option structure, and that'll start to make money if the market goes below 45,000, which coincides with that technical level that I spoke about on the chart. But now I don't want to pay out that full amount of money. I'm happy to then sell away some of the risk. So what I've done against that is I've sold one out the money put option. I've sold a 41,500 strike put option. For that, I've then received 3,097 Rand premium that's paid to me. I've then sold an additional one put option further out the money. I've sold one Aussie put option with a strike of 39,000, and for that I receive 1,461 Rand. So I've sold 2 out-the-money put options, essentially, against the 1 at-the-money put option that I've bought.
Yeah. And out the money being, the market would have to fall a hell of a lot in order to hit that strike level.
That's correct. That's it. So that's why we talk about it being out the money. That's a lot lower than where the market is currently. I've sold another option as well. I've sold an out the money call option as well. I've sold a 51,000 strike call, and that I've received 3,711 Rand for that. So if you look at this, we refer to that as actually selling the wings. And if you look at it, I mean, I've sold out the money put options and I've sold out the money call options. That's basically where we get the term selling the wings. Okay. And I've used the funding from the sale of those calls and puts in order to finance the purchase of a put option with a strike of 45,000. So I know it looks complicated. That yellow line that I've just put onto the chart there basically tracks the overall payoff of this structure. And if I tidy it up a little bit, essentially this is what we get. And keep in mind, this structure runs out to the middle of September, so we've got about 3 months to go with it. Below 45,000, my structure starts to make nice money. It makes money all the way until the market gets to 41,500. At that point, I can make a maximum of 34,000 Rand on this trade. Okay. It'll continue to make money, and only if the market then falls below about 35,000 odd, then I would start to lose money on that structure. So a very, very nice, broad, profitable area that we're talking about there. If the market stays above 45,000 and anywhere between 45,000 and up to 51,000, then I only lose my premium, which is 891 Rand. So I've paid 891 Rand premium for something that could potentially make us 34,000 Rand in the event of a big market fall. However, the danger zone for us kicks in at 51,000, where I'm short a call option, and there I could start to lose money. But that's a long, long way away at this stage.
Although we said that at the beginning of the year when you put on that option structure, and we saw the market rally to levels that we hadn't anticipated it rallying to, and then you had to do quite a lot of nimble sort of footwork around that.
Yes.
So obviously you have that in the back of your mind.
I've absolutely got that in the back of my mind, and that's still very fresh in my memory from last quarter. But I'm comfortable with this. 51,000 from here, it's another 6,000 points above where the market's trading at the moment. So I'm not very worried about it. And also keep in mind that I think the pound is likely to remain weak following this Brexit result, and a weak pound implies a strong rand. And when we've got stocks like BHP Billiton, British American Tobacco, SAB Miller, those are all sensitive to what the rand-pound exchange rate does. I struggle to see those shares going a hell of a lot higher. So I think we'll be fairly safe by selling the out-the-money calls in this case. And I'm more inclined to think that we're well positioned here if the market does stay weak in the third quarter and it goes below that 45,000 support level that I spoke about on the chart of the top 40.
Yeah, if you had to overlay it against the charts, you've got the September futures.
So here we go. Now this is again that chart of the top 40. Now I know the scale looks a little bit squashed up, but I've had to do that for the following reason: is that if we actually if we overlay the payoff profile of this option structure onto the chart now, there you can see the middle of September where the structure expires with the futures closeout in September. Below 45,000, there you can see it starts to make money. It makes money all the way down to 35,500. And only all the way up here at 51,000 would we start to lose money if the market rallies hard. But the nice thing for me is just from a technical standpoint, that lateral resistance level there on the top 40 is very clear to see. And if we continue to break below there and stay weak into the third quarter of this year, then this structure is very, very well positioned for that.
Okay, Garth. So just to wrap up, what does the portfolio look like? And probably not much change from last week.
No, in terms of the portfolio value, it's very similar to last week. I've just accounted for the 891 Rand premium that we've had to pay away for this structure. There you can see the 4 different legs of this option structure clearly illustrated. We've got 268,000 Rand in the portfolio, so we're still up 7.3% for the year to date, which is fine. And I think we're quite nicely positioned now as we go into the third quarter with a lot of uncertainty around.
And then to end off with your next courses.
Yeah, so we've got a couple of courses coming up in July. My colleague Andrew Todd runs a top 40 futures course on the 2nd of July, and then I'm running a Understanding CFDs course on the 21st of July and a high probability trading course on the 23rd of July, all of these in Johannesburg. So anyone that would like information, please email me, garth@traderscorner.co.za, and I'll send you all the details.
Great. Garth, we'll leave it there. Thanks as always for joining us. Garth McKenzie is founder and editor of Traders Corner.
Traders Corner is brought to you by IG.